When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news! You found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade, and of course, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing?
Doing great. It's always good to be with you on this beautiful weekend, and hopefully we have some fun today again.
Yeah, likewise, too. It's always fun when I'm talking to you on the radio. Hope our listeners enjoy our show today. We've got a lot to talk about, Jeff. Of course, we have listener questions coming up here in the second half of our show. But I want to start off with something that has come across my desk here in the last couple of days. Dow has reached 40,000, which is sort of a monumental milestone. In this past week, the Dow was even above 40,000. So what can we make of this? And let's go back to when you first got into this business. What was the Dow when you first started financial planning?
It was in 2000 range. It was, in fact, I got hired right when they had that crash in 87, and it was like a 500-point crash. What was just devastating to the market, you know. And what's a 500-point crash? Like a 27% drop in the Dow from, I believe it was the low 2000s, if I'm not mistaken. I don't have those numbers imprinted on my head, but it was low. I mean, figure the Dow's up 20 times what it was back in 1987, and okay, so now you know how long I've been, associated with this business. Yeah, I dialed for dollars for a few years, and I'll tell you what, I thought, coming into the market right when it had tanked, I thought, wow, what a great opportunity. Everything's low. People are going to want to buy. But I'll tell you, for about 5 years, everybody was scared, and it was really kind of hard to be a brand new guy and get new clients. The other thing that I learned was, I learned a lot of things, speaking of when the Dow back then, when it was low, and I think I might be deviating from your question just a little bit, but, I realized that, all we were doing is peddling risk, man. All it was is upside and hope. And, if you look at the long term, everything's fine. But if you look at the short term, it can pop down and be pretty devastating. Back then, that was during my career, the first of a few big crashes that were, really took its toll emotionally on the investor. And since then, we've had a few more. But the market's being manipulated a little bit more lately. We've got money printing going on ever since Obama took in office. And we've got some kind of artificial manipulation of the market that's making it go up probably a little bit more than perhaps it should, or perhaps historically it should be as far as valuations go. But nevertheless, more buyers than sellers mean the market goes up. We also know that time and compounding of interest, if you can average 10% per year growth, you're going to double every 12 years. And if we go back to 1987, where I was talking about just when I got in the market the very first time, the 2000 range to double to 4,000, then it doubles to 8,000, 1632. So it's really only doubled 4 times, right? And so if we use, a 10%, or let's say if it's doubled 4.5 times. So let's just say, okay, it's doubled 4.5 times in how many years is that? 40 years. So roughly it's doubling every 10 years. So that averages 7 or 8% compounded annualized rate of return. Well, that's just the compounding effect of interest. It's not really surprising. In fact, if you look at it in 15 years, it ought to be 80,000 and 100,000 probably in 20. So yeah, once the numbers get big, they get bigger faster. So it's not necessarily surprising. And I think the milestone is it's just another reason to cheerlead the market and make it sound like everything's okay. But when we look at earnings, and the Dow is only 30 hand-picked stocks. We've got some that are in there that I think will probably get kicked out soon. Like Intel hasn't really been doing, it hasn't been a barn burner. You've got Home Depot and, some of those things that were doing great during the building. Chevron's in there. It was doing great during the energy rush. Now it's getting a little bit soft. We've got a few really big financial companies. We've got Amex, Goldman Sachs, JP Morgan. Those companies were basically handed money from the Fed over the last couple of years to buy their own stocks. And we just found out last week that Jamie Dimon of JP Morgan, for example, said he was thinking he might retire a little bit earlier and that he wasn't planning any stock buybacks. anymore because the prices were too high. He alluded to that very strongly. The market kind of interpreted that meaning, oh no, the financial market's going to go to heck in a handbasket now. And you kind of wonder, if that was just a knee-jerk reaction. I don't know that that's going to be the case, because I think in an election year, the Fed's going to continue to work in cahoots with the financial markets and probably prop them up. But bottom line is Jamie Dimon of JP Morgan. And if Jamie Dimon says stuff, typically the market will move. And, it's not quite as much as when the Fed talks, but at the same time, he's a voice that the market listens to. And if he's getting out of the market, he's trying to get out at a good time. I'm sure he's going to do his own, cash in his stock at the high as he can. He's already sold, I think it was over 150 million of his own money. I think that was the number just a few weeks ago, and probably will be selling more, because I think he knows he's not going to get a better price. I think everybody knows that there's a recession imminent. Speaking of recession, if we just look at the last 2 quarters, the GDP growth has gone down the last 2 quarters. Now, that used to be the definition of recession. When things are slowing down, inflation is going up, and by the way, it's out of control. We can talk about that more again. I talk about that every week, but it's not, in control like they claim to make us want to believe. And we're just seeing the underpinnings of what typically precedes, market correction or even a crash. But we're also getting some manipulation by the government, manipulating interest rates a little bit, saying they're going to lower interest rates, saying inflation is really under control. And there's a lot of things that are, I think, hyping the market or making it do a little better than economically it should. Just because the market goes up doesn't mean the economy is on good footing. It really isn't. And anybody who looks at the numbers knows it isn't. If you look at a bigger index, the S&P 500, it also created new highs. We hit over 5,300 and probably be bouncing around there, and maybe even 5,500 before it tops out. But I don't think these indexes have a whole lot of gas left in them, because they're really trying to squeeze blood out of turnips here. Every last drop, and I just don't know how much more you can get. But then again, I've been surprised so far. I've been surprised at just how resilient the market is. I'm not going to say resilient the economy is, because the economy isn't. GDP growth is slowing. Prices are going up. You get companies that actually show how the economy is doing, like Target. I mean, that's a good short sell opportunity, if you ask me. That company's starting to see sales go down. I mean, even the middle class people can't buy as many, $5 T-shirts and things like that Target's known for. So, I may be exaggerating a little bit, but we see the consumer spending going down. We see every inflation factor going up. There is a lot of pressure economically, yet somehow the market is still being manipulated up. And it is manipulated. It's probably the most manipulated bubble that I've seen. But congratulations for hitting 4,000. Does that mean we should jump in? I think if you jump into anything market-wise, it should be underscored by at least some fundamentals that mean that they're actually making money, their earnings are growing, that they're in good financial shape, and they've got a chance to weather storms ahead. And I also think that even if you have good, solid companies, if the market corrects and, a lot of activities that are going on suggest that it may soon, or if not sooner or later, then I think even good stocks will go down. So you have to be very careful, I think, how you play the market. The way the indexes are going, maybe just play the indexes, and as soon as the index gets off, kind of, go to the sidelines if you can time it, or if you want to try to outguess it. But again, I think the market is a place where you put long-term money, just like we said. It was 2,000 back in the day, and now it's 40,000. Does that mean you've made a stellar return? Well, you've had a few gut aches along the way, but if you had $200,000 back then, now you got $4 million. So it's done its job. But then again, you think of inflation, housing, all the other things that have gone up as well. $200,000 when I first started in this business, if somebody had that kind of money, that was a lot of money. Yeah. Now millions is very common. So again, it's all relative. Things are going to go up. Inflation's going up. Prices of the stock market's going up. Prices of houses going up. Income's going up. Everything's going up. What we want, though, is that there's some sort of an orderly, methodology that you can look at to see when it's justified and see when it makes sense to be in the market and when it doesn't. I think right now it makes less sense to be in the market if you need your money right away, because I think there's just too much risk. But if you don't need your money for 5 or 10 years or more, I think you keep dollar cost averaging in. It doesn't really matter what the market does. Over time, it's always going to go up. And that is true. I'm not going to dispute that. But I will also not let the market or those people that are cheerleading the market forget the words that, hey, the market's volatile. And if you're using that money or in the imminently need of that money, you don't want to see volatility affect your retirement plan, because your investments need to turn into income sources rather than growth sources. So again, it kind of depends where you are in the timing of your accumulation phase versus the distribution phase. But, I'm glad to see the Dow up there. I think it might have just hit was kind of a milestone. And if it doesn't go up there and stay up above that 40,000, I think that'll be kind of a ceiling that's going to be hard to break through and stay through for a long time if it doesn't. But then again, if it breaks out and the White House and the Fed work with Wall Street to continue to prop the market up, at least through the election time, then we may still see some, maybe choppy, but maybe some upside ahead. I don't have a crystal ball. I invest based on not just gut feeling, but I like to add fundamentals to the equation. I know that hasn't really been the case. You can't really even include fundamentals in what the market's done the last few years. So, maybe there's a little bit of a disconnect there, but maybe I'm a little too old school. But one thing I'm not old school in is I know that if you're in retirement using your money, you can't afford to take losses, and you shouldn't have money in the market you can't afford to lose. And that is a quote by DOW back in the early 2000s, right after the market crashed in the dot-com bust. So I do hold strongly to that philosophy that if you need to use this money in retirement, it's really nice that we can make 5% on short-term bonds and 8 or 9% on some private equity things that we, have. And, our annuities are up, some between 10 and 15, some even over 20 on the indexes because the indexes have done well. And that's, just since a year ago. So, there are upsides without risk, opportunities where although we can cheer the market on because we have exposure to the market from the standpoint that our index products still go up and benefit by good markets, but they don't go down if the market crashes. So I'd rather have my market-related money in something that's principal protected at least and still gives me some upside, when the market's defying gravity like it is right now.
We're talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the Dow hitting 40,000. And Jeff, you alluded to the fact that the S&P 500, the NASDAQ is up. S&P 500 up 23%. The NASDAQ is up 27%. For those people who are still excited about the Dow reaching 40,000, they're very optimistic about this, and they're somewhat risk takers. And as you said, safe money, there's certainly a place for that, but I think without risk, there isn't much reward. So let me ask you this, with the Dow at 40,000 as it is, do you think there's still time to get into this market to take advantage of this? And should we be even thinking about getting into a market like this?
Well, if you've got a long-term horizon, it's always fine to get in the market. I would go in easy. I wouldn't take your money out of a CD right now and go right into the market. I think we kind of missed the upside. There's typically, a roller coaster ride in the market. We're bound to have some sort of a correction. We had such a good run. And, you went back to a year ago for the 23 to 25% gains that we've had in the market. But remember that, if we go back, 2 years, it isn't much better. If we go back to the height right before it started crashing in the 2022, really, we're only up about 15% in the last 2.5 years. So again, we've made new highs. Is that roller coaster ride been worth that much gain in the last 2.5 years? It's nice that we're back, kind of on a roll. But is the growth of these companies that are priced at these levels right now, are they making the money that justifies it? And honestly, companies were more profitable and growing at a faster clip 2.5 years ago than they are right now before, inflation started affecting them, before interest rates started affecting them. So the companies are not growing to support the stock growth. There's a lot of interesting statistics. I got to mention this, that Jared Bernstein, that guy, what a buffoon from the White House. He's the economic spokesman, I guess. I don't know how, what do you call it? But he says, inflation's up, but wages are growing better than inflation. Excuse me? And they call him out on it. And he's like, he doesn't even know what he's saying. He says, the Bidenomics is empowering workers. The low to mid-range job growth and wage growth is so high. It's like 4% from a year ago. Well, inflation's supposedly on about a 3 to 4% annualized growth rate. Of course, those numbers are kind of fibbed down and then they're revised up later. But if we look at the actual inflation since Biden took office, we're about 25%. On actual inflation. Well, if wages have grown 4% in a year, let's just say they grew 4% the year before, which they didn't. Okay, so wages are up 7 or 8%, and that just does not play out to me. Let's look at a couple of things. The deficit is growing by $1 trillion every year. Debt is growing by $1 trillion every 90 days. Home prices are up 30% in the last couple of years. Mortgage payments are up 176%. So the home prices, the home payments are up 140%. Electricity is up 30%. Yeah. Gas is up 50 to double, depending on where you buy it and how much taxes they're adding to it. Savings before Biden, inception of his presidency, savings was at $2.1 trillion because debt is at an all-time high. Personal debt is all-time high. The number that I read was the savings is down to negative $72 billion. That means, $2.5 trillion has gone somewhere, either into the market or, savings is down. No, that's been spent, but yet they pumping money into the market and making the prices of stocks go up. So, the hours worked, even though wages are up 4.3%, hours worked are being slashed. we've talked about this before, tens of thousands of people being laid off from, Meta, Amazon, UPS, Spotify, all these big companies that, were really growing gangbusters, and they're just letting everybody go. And these are high paid jobs. So what are they doing? They're getting these low paid jobs that are typically government generated jobs in order to pad the employment numbers, the new jobs numbers. They're all minimum wage jobs. Almost 9 million people in America have to have a second job. That's the highest it's ever been. Housing starts, housing permits have been slashed. They're going down. Manufacturing in every category and in every sector of America is all negative, all going down. So, we got these, I heard the term, the Wall Street gangster banksters are all together colluding with, market manipulation by buying their own stock. Although Jamie Dimon did say enough's enough, we're not doing it anymore. Apple came out with an announcement that they're going to buy back, $110 billion? Was it $110 billion? Yeah, $110 billion of their own stock, or they have an approval to do so, but they haven't yet. Nevertheless, the stock goes up because, the market makers throw out a big price and everybody goes, yay. So the news, basically, the fake business news, the fake Wall Street news, is really telling everybody, is basically taking space inside the tourist advisors' heads, mostly the people on the street, and, give them this false hope that there's something supporting this market, and there really is nothing other than gamesmanship. And, we can ride on that. If you're okay with the gamesmanship and you know that the government's good at it and you know that the Fed's been getting better at it and the banks have been riding right alongside them, we could jump on it based on those facts and those promises. Honestly, it makes me nervous, though, because they could pull the rug out as soon as they feel like it, too. Or if the market just decides to take a big old puke, it can bomb in spite of what they're doing to manipulate. As soon as enough people decide to be sellers, there's not a whole lot of manipulation that can overcome enough selling pressure in the market and absorb it all. So I think right now, everybody listens knows, I'd rather err on the side of caution, knowing that we can still make money, a decent amount of money. And right now, even 5% is keeping up with the annualized inflation rate, even though I think the annualized inflation rate's being maybe it's a little bit better than that. We can make 8 or 9 on some safe stuff. The new indexed products are going up because now that the insurance companies that are offering the LIRP insurance type products and the fixed indexed annuities that go up with the market, now that the companies are making 4 or 5% on your new money or more, because they're investing in a bond ladder that will support them and their income for the next 10 or 12 or 20 years, they can offer a much higher participation in the stock market than they have ever been able to offer before, which gives us another opportunity that people that bought annuities that are principal protected but go up with the market. Some of these older annuities are, capping out between 2 and 5% in the best years and have fixed interest rates down around 1. Well, that's all the company was making on your money when you gave it to them. So it stands to reason that they can only do so much with that. But, there's an opportunity to refinance some of those old fixed products into the new ones and make a seriously good amount of upside with little or no risk. So, we've answered that question. And that's probably, I just want to explain why I'm so cautious on being all in the market with all the upside that we've seen, but all the downside that could happen seems like a bad risk. I think there's more downside potential than upside potential. Now, could I be wrong? Yeah. Well, why don't we just do it a different way so there's no downside potential and reasonable upside potential, especially if you're trying to protect your assets that you've worked a lifetime to accumulate, and especially if you're trying to protect those assets for retirement and income.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about the current events and what's going on right now with the Dow, the S&P 500, and the NASDAQ. They're up, and whether or not it's too late to get into the market. Jeff, despite all the good news in the market, I still see these dire warnings of recession every day. I look at the news. Do you think we really have to worry about a recession at this point? We've been waiting for it for years now, and it just hasn't happened. Maybe it's never going to happen.
Recessions always happen. I mean, technically, we're in one now. If the GDP is not growing, it's going backwards 2 months again. It's done that a couple of times, but we also know that certain cycles that always seem to complete, historically they have, may not happen for 2 years or so. When the yield curve inverts and stays inverted. Now, it kind of inverted a little bit and kind of popped around beginning of 2022 when the market was crashing, but then it stayed low with all the interest rate hikes. The long-term interest rate stayed lower than the short-term. Short-term interest rates ended up getting higher than the long-term rates after a few rate hikes. So, about a year and a half ago, there was this inverted yield curve, and it's been like 500 and something days. But when the yield curve inverts, meaning it's kind of out of whack where short-term interest pays more than long-term interest, typically we get to a point where the Fed decides, the economic numbers aren't looking too good. We need to lower interest rates, not just to help the market. Now, they've had a lot of rumors that they're going to lower interest rates, and that has helped the market because everybody's looking forward to, what might happen. Everything's forward-looking instead of actual happening. So, we go down this road, and these cycles don't always just, go down and flip and end. Right now, since that yield curve inverted, it's been 500 something days, and typically it happens within it happens usually within about 700 something, about 2 years. So we still have some time to go before that yield curve inversion, historical 100% cycle correction that always can happen. So what happens usually is the Fed decides when they start seeing the economic indicators not looking too good, they'll lower interest rates. The recession typically happens after the first rate decrease. So while the hype has been, we're going to decrease rates, and the market thinks, oh, great, if they decrease rates, that means cost of doing business is less for all these companies, especially the tech companies. This is going to be great. Let's keep buying tech, because if they're going to lower rates, they're going to make more money in the future. So let's just buy up the stocks now. But what happens is when the Fed actually does decrease rates, it's because there's some recessionary pressures. And then people realize, things are pretty bad. Maybe there really is going to be some economic pressure on the market. Let's get out. And that's when typically the crash happens. So if we look at the last big recessions and the crashes that, more than the 20 or 25% corrections, is if we would call that a crash, they happen after the yield curve doesn't necessarily invert, but it usually gets close. And then there's a rate decrease, which kind of helps that yield curve inversion cycle end. And then there becomes a recession. So we're still in the time frame that it typically happens. What also bothers me is what I said before is, savings, has gone down to almost negative now, where there's more borrowing and credit and delinquent credit out there than there was savings. And that isn't going to be propping up the market. The Fed can only manipulate interest rates so long before, they just have to, buckle down and kind of put things on pause and maybe even look at reducing the interest rates, right? So, we see the manipulation. I mean, the Fed isn't necessarily lowering interest rates, but, for the past few weeks, they've been propping up bond prices, which kind of effectively lower interest rates. And the market's seen that and, kind of given a little bit of fuel to this rally to, see the Dow at 4,000 and NASDAQ and S&P making new highs as well. So, I don't know that, we can keep on manipulating the bond prices and the interest rates that way for too much longer. So I think we're probably going to see the market somehow try to react and get back to kind of a normal historical price range sometime in the near future. I don't think it's going to be that much longer before this thing comes to an end.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And Jeff, based on our conversation, I'm sure that our listeners may have some questions of you. So we're offering this opportunity right now for our loyal listeners to get in and sit down with Jeff and talk about the market, the economy, the Dow, the NASDAQ, the S&P, basically to talk about your individual situation, where you are, and how you can get to where you need to be in retirement. We call it our Premier Retirement Roadmap. We're offering it to you today, no cost, no obligation, just a casual conversation with Jeff on a one-on-one basis. To get yours, call 520-780-9059. It's 520-780-9059. I know it's the weekend right now. Go ahead, make that call while you're thinking about it. It'll take less than 60 seconds to do this. Shelley will give you a call back during the week and set up that appointment for you. Once again, our telephone number, 520-780-9059. There's no cost for this call, absolutely no obligation whatsoever to have this conversation, and certainly no judgment. So take advantage of the opportunity right now. 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, time for a break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Ogan and Jeff Shea.
We so much appreciate you joining us here for Premier Retirement with Jeff Ogan each and every Saturday. We're on the air for you 4 times a week. We're on Saturdays at 7 a.m., also 9 a.m. and 1 p.m., and then on Sundays at 11 a.m. And as always, if you've missed any part of the program, you want to hear the program on your schedule, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Ogan. You will find this show and many, many of our past shows, and take a listen to those so you can stay on top of your journey towards a confident retirement. Okay, Jeff, We have listener questions this week. We always answer 3 of them. We'll kick it off with Greg in Tucson. Greg writes, I have a simple portfolio. I have a pension worth $800,000 as well as $470,000 in investments. My financial advisor is asking me for over $4,000 this year for her to be available to me. I feel obligated to continue to use her, but I believe I can manage my portfolio myself. I don't want to make a decision based solely on the cost. So what else should I be considering? Does that amount seem fair, or is it time to DIY it? $4,000 a year with $800,000 and $470,000 in investments.
Well, yeah, that's a fair question, Greg. If you can do it better, then you should do it better if you're not getting value. But 1% is typical in the industry. I don't, especially on a $470,000 account. Yeah, I don't know any advisors that would negotiate that rate down. Maybe if you had $47 million, you'd get a 0.25% or 0.5% on that. Right. But you're not in a position, I don't think, to negotiate. $4,000 seems pretty cheap. If that person has 250 client base and $1 million overhead to keep the doors open, you're just keeping the doors open before your advisor makes any money. So understand that, for us to be in this business, I know my overhead's over $1 million every year just to keep my doors open and to be on the radio and to, inform my clients and to pay my overhead, pay the team that does my trading and research, pay some of the fees that I make to, sub-account managers that do a lot of research that I'm not doing because I'm visiting with clients and updating portfolios and, building business plans. It's not like, they're sitting there without overhead and not needing those fees to exist. So if there's value and you're going to that person because they, help you or help you understand how to manage, I don't know, what experience do you have that says you can manage your portfolio yourself because you're just going to buy an index fund and sit and let it ride? Honestly, if that's all you're doing, if that's all your advisor's doing, then you should run. That's a stupid fee. But if that person is giving you some tax planning, like telling you how much every year to put into a Roth IRA in order to, save taxes in the future, you might save a lot more than 1% a year just in the tax savings that you might get over time. Like, let's say you have a good tax plan that over the next 5 years costs you an extra $10,000 in taxes, but for the rest of your life, you save $10,000 a year in taxes. Okay, so in 10 years, you're more than broken even from the fees, and then ongoing, you're making money from the standpoint of just having a simple strategy implemented that you didn't think of yourself or didn't know how to do yourself or weren't watching yourself. In our firm, we have access to a CPA at a very reasonable price that does an incredible job of saving and squeezing every last penny of tax savings out of your account. That might save you an extra few thousand in taxes. That could go towards those fees. Just monitoring the plan, telling you when to get out of an old annuity that pays low interest and has low caps and maybe high fees into something new that has no fees, higher caps, higher participation rates, higher income potential, higher fixed rates, and so forth. Would you know about that? Unless you went to every seminar in town and kicked tires all over town. You'd be spending a lot of money just to try to find out all the information that you would need for maybe these other aspects of your financial plan. Now, in our business, now 470 is all you have and everything's under management. And honestly, it's not even anything but passively managed, but you're helping keep the lights on at your advisor's office so that you always have an ear to bend if you need to, or you have some advice on different investments or tax strategies or other things. If they offer those things, then, I don't think you're overpaying. But, that's me. I'm in the fee-based business. Now, I'll tell you how our fee structure works is we have a similar fee. Our company typically makes 1% on assets that we manage. However, that fee pays for us to look after and manage assets that aren't necessarily fee-based. For example, if somebody has a LRP, the insurance company pays us typically one time or pays us a residual, so we don't charge a fee on that. Annuities, typically a one-time, kind of a marketing reimbursement commission, if you will. But it's typically one time. And honestly, on the annuity and life insurance business, if you consider what you'd pay in fees compared to the commissions paid, you'd pay more in fees over a 20 or 30-year retirement than you would. So if we can reduce and only charge fees on the managed portion, so let's just say you had $470 and you're paying $4,000, but you had another $500,000 that were in income annuities that you were getting annual reviews on. And then you had a LRP that was saving you maybe $5,000 a year in taxes because you put another $500,000 in there. You've got $1.5 million under management. Technically, you're saving $10,000 a year in taxes because you funded a LRP when you started retirement, and your fees are $4,700 a year if it's 1%. So I think you're getting off cheap if you had the more comprehensive plan. At least you would be at our firm. But again, if I was, dinging you for fee on everything and I wasn't doing a whole lot, I could see why you'd be concerned and, why you might want to be concerned. But again, if you've got the pension that's paying all your bills and you want all this money at risk, but, don't really want to be a stock picker and, your advisor isn't either, and they're just putting you into a couple of ETFs, exchange traded funds, or just an index type fund like the Qs. QQQ is more of the tech index, and the S&P, the spider for the S&P 500. I mean, you could do that on your own at almost no fees and do it online and just let the market ride. Over time, we talked about it earlier. Over time, you're going to double your money every 10 years probably. On average, you probably do a little bit faster than that, but there might be a decade where you don't make anything. If you don't need that money, maybe you don't care. Maybe you'd rather save the fees than worry about having somebody to call when the time comes. But I will bet you that there will come a time when a phone call to an advisor that knows something more than you know, or has access to a product or service that you don't, that could make you a lot more than $4,000 and maybe even save you more than $40,000, maybe 10 years in fees. So again, it's just up to you. I mean, you can be a fee weenie all you want. I don't say that's a term of endearment to those that don't like to pay fees. It's not a dig or a cut. It's just, okay, so what? But if you are getting value for having the advisor, then stay with it. If somebody wants to walk because they don't feel like we're adding value, they can, and they don't have to pay a fee anymore on that money. They can pull it out, go into CDs, and make passive 5% at the bank till they can't, and then if they want to come back and do something more in the market, I don't know if I take them back if they left. But anyway, we don't care. It's just, if you think we add value, then let's add value. If you think you can add value better yourself, then go do it yourself.
And I'm also going to echo your sentiment, Jeff, about what this advisor does. If she's doing more than managing your money, answering those questions, her fee very well may be worth it. But Greg, thank you so much for listening to us in Tucson. We'll send you out Jeff's book, Retirement: The Road Ahead. Okay, Jeff, next question is Archie listening to us in Vail. Archie writes, I'm 73 and my 401k hasn't been doing well for the last few years. Would it be a good idea for me to withdraw my money from my 401k and pay the tax that I will have to pay eventually anyway, and then invest the rest of that money in a CD?
Well, I don't know how much you have in a 401k, but typically 401ks are things you've had for a long time at work, and they might be hundreds of thousands or millions. And if you pulled all that out at once, you'd probably be in the max tax bracket, maybe somewhere in the 40% range on the top end, which you may not ever hit if you just take it out over time. You can move a 401k to an IRA. You can even move a 401k to an IRA at a bank and get a CD with it. Or you can move a 401k to, a company like us that has access to CDs. Now, this would be fee-based. Let's go back to the last question. Yeah, this for a fee, we could manage assets in high-paying short-term bonds, high-paying meaning over 5%, minus a fee. That would be liquid. Go into the market when it looks better and maybe take advantage of the upsides. I'm guessing that what's been hurting you the last few years is bonds. Bonds have gone down 20+%. Anything over 10 years has gone down more than 25% and is still down. They have not come back up. So if you had a 50-50 split between the market stuff and bonds, you're probably down 10% because the market went way down. It's back up 10 or 15 over that period of time, but it's taken 2.5 years to ride down and back up. And we don't know if we're a little top heavy, and we could easily have a correction that gives away 10 or 15% of that anyway. So, I don't blame you for being upset, but you're in good company. There's a lot of people that had a stock and bond portfolio because all they had been exposed to was stocks and bonds. That's all they had access to in the 401k. They never found out because either by your own, lack of curiosity, went out and found out what there might be as far as an alternative to that 401k. For example, our indexed products, they're bond-based from the standpoint that insurance companies invest your money in bonds. Their portfolio's down, yet they're still guaranteeing your principal at the same price it was 2-3 years ago. So while some people are upset that they haven't made any money in the last few years on an index product, yet because the market's so strong, but we weren't in the market. We were in something safe. The only other safe thing that, Wall Street would have pitched you was a bond, which is down 15 or 20%. Who knew you could lose 15, 20, or even 30% on bonds? That wasn't the case over the last 40 years because interest rates were trickling down lower and lower. And as they did so, the bond prices were up higher and higher, which, made bond funds and bond ETFs and just even holding any bond, worthwhile proposition. But that hasn't been the case. Now, if interest rates start going back down again, bonds will get some traction. I don't know that it's worth holding on to them because honestly, I don't think we're going to get down to 1% interest again. I don't know. That could happen, but I just think it'll probably stabilize somewhere in the 2 or 3 range, maybe at the lowest. And if that's the case, we have some upside in bonds when that happens, probably during a recession and when the interest rates get dropped again and that inverted yield curve reinverts the right way. there might be some upside in bonds, so you might get some of that back if you just write it out. But my opinion is if you want out because it's not performing, you ought to consider rolling that 401k to an IRA, not necessarily with a bank, but with an advisor that can offer you products and services that are principal protected. And by the way, I said this, I'm not going to tell you how high some of these index products have gone from a year ago. I own some myself. I'm really happy with the returns. You can lock them in anytime you want to and say, hey, you know what? I'm happy with the return. I just want to, keep it right here for the term of my market exposure. Lock in some upside. 10% or better is very common in the new products that we have that are issued based on the higher interest rates that we're experiencing today. You might want to go that route because I think over time you'll beat whatever you could make in a CD, even short-term or long-term. I think over time those products will outperform. I also think that, working with a fiduciary company like us who has access because of our big buying power, because combining all of our assets with me and the network that I belong to, we have access to some private equity funds that usually you have to have a lot of money, maybe sometimes billions of dollars to participate. They don't like a lot of clients, but we can manage clients, pool our money. And if you're an accredited investor, meaning that you have $1 million net worth or higher, typically there's other parameters for that. But if you're an accredited investor, you can participate in some of these very low risk, very collateralized private equity deals. Last year, my favorite one that's probably got the best risk reward relationship, meaning very little risk, made 9.5 last year. So, why not make more than a CD? Keep your money relatively liquid where you can get at it and do something different with it in the future and still have your 401k. But most of all, not pay the taxes now, but create a plan where you take the taxes out over a period of time while you're in the lowest tax bracket possible. So in other words, maximize whatever bracket you're in right now, take that money out, pay the taxes at today's tax bracket, knowing that the longer you kick that can down the road for pulling that 401k or IRA money out, the higher your taxes could be because you'll have more money growing and will likely be in a higher tax bracket as the Trump tax cuts go away after the end of next year. And there'll probably be some rate hikes depending on who gets in the White House the next couple of terms. So I think between now and the time you end your retirement, maybe 20 or more years from now, it's very likely that we'll have somebody in the White House is going to raise taxes and, kind of force that issue. I don't know that politicians can do math any other way than spend and tax and just collect more to offset, the money that they're spending. A good businessman in the White House, might say, hey, lowering taxes actually creates more economic activity, which creates more taxes. And at a lower rate, we actually collect more, which is exactly what happened during the Trump administration. So it kind of depends on who's in office as far as how the taxes will go, but we can do the best we can with what we know. And right now we know that taxes are at pretty favorable terms. We ought to pay some taxes at a good rate, but don't force yourself by taking a ton of money out of that 401k. Don't force yourself into a higher rate now or a higher rate than you think you might be at in the future now that you're 73 and have to start withdrawing money out of those retirement accounts.
Archie, thanks for sending in that question. And of course, thanks for listening to us in Vail. Your book is on the way. Next question is Maury listening to us in Casa Grande. And Maury writes, Jeff, I'm 67 and I've been a widower for the past 2 years. I've just sold the home my wife and I owned, and after expenses and paying off debts, I have about $550,000 in cash left. I'm still working, earning about $60,000 a year, and collect $3,000 a month in Social Security benefits. Right now, I'm renting a home and not looking to buy again soon, if at all. I'm wondering about taxes due on the proceeds of the home sale and how to best invest the $550,000 in cash that I have left to allow me to retire in 1 year.
Well, that's an interesting question. There's a lot of opportunities that, you could do. Now, first of all, you're a widow for the last couple of years. You do have a $250,000 exemption on the profit of that home. I don't know what you bought it for, but you might have to pay some taxes if the profit was more than $250. But let's just say you paid $300,000 for it and it's worth $550 now. And by the time you pay off everything, you have $550 left, and that's, a wash. So assuming you don't have any taxes to pay on a portion of that. Now, if that's all profit, I don't know what the situation is. But bottom line is you're making about $60,000 a year. You're 67. I'm guessing you probably want to maybe retire sometime in the next, let's say 2 or 3 years. I can show you a place that if you had $550 left, that you could guarantee an income that would replace that $60,000 a year starting at around age 70. Or very close to it. And that would be using index annuities with income riders. You would still have access to the balance of the account should you need it. You could still have access to, let's just say you had a terminal illness or long-term care stay or something like that. Those assets would still be available to you if you needed to accelerate the spend down. But if you live 20 or 30 or 40 years, it would, and guaranteed you, potentially $1 million or more in income. And if the account didn't perform, the company has enough liquidity and surplus and reserves in order to continue to pay that income. I can't do the numbers. I can do the numbers pretty close in my head, but I think you'd be pretty close to a wash if you work 3 or 4 more years and wanted that 550 to create an income stream. Now you might, say, well, I don't really need the 60,000 a year. If I retire, 3,000 a month is plenty to live on. I just want to swing for the fences, and try to make money in the stock market because I want to leave my kids rich in 30 years. Well, you're not going to buy a home. You're probably going to have some, increased rents. You're probably going to need a little bit of extra income. And, if you didn't work 3 more years and you retired like in a year, which I think you might have said in your question, if I heard right, you might want to just spend down a little bit of, what could you live on? Do you need the $90,000 or $80,000 net to live on, or can you live on 60? We could strategize an income plan that would give you some guaranteed income to make up the difference, whether you take it a year from now, or whether you take it a few years from now. If you have a few years to wait, income's, going to be higher, but if you could live on less, then take a little bit less income and do it right away. Again, let's just take a look at it and look at the picture, and basically we put it out to bid. We're fiduciaries. We go out to wherever the best return on your investment is for the purposes that you want the investment for. And I'm assuming that you want it for income replacement, so I would look at those income guaranteed annuities with income riders that guarantee a payout regardless of performance.
Maury, thanks for sending in that question. I think we need a few more details to give you a good answer there, but we appreciate you listening to us in Casa Grande. And of course, we will send you out Jeff's book, Retirement: The Road Ahead. If you've got a question you'd like us to answer on the air, don't hesitate to send it to us. You can go to our website, which is premret.com, premret.com. Put it in the contact page there, and if we answer it on the air, of course, you'll not only get your question answered, but you will also get Jeff's book, Retirement: The Road Ahead. So go ahead. If you've got a question for us, you can get it to us by going to premret.com. You can also call it in if you want, 520-780-9059. And while you're at it, when you call that number this weekend, be sure to request your no-cost, no-obligation retirement roadmap. It's 520-780-9059. 520-780-9059. No cost, no obligation for that. We would love to have the opportunity to sit down with you and get your questions answered in person and get all the details that we need to give you a good answer. Again, no cost, no obligation, 520-780-9059. Go ahead and make that call this weekend. We'd love to hear from you, and we do have some slots available in the very near future for you. So take advantage of this opportunity that's not going to cost you a dime. 520-780-9059, and remember, this one call could make all the difference. Well, Jeff, once a year, I go to the doctor so I can get an annual wellness check because I want to know if there's anything brewing under the surface that I need to take care of before it's too late. And the same goes with your financial plan. I think that at least once a year, you should have an annual wellness check. So, Jeff, when you do an annual review with people, you take a look at their financial plan, what are some of the key areas that you concentrate on?
Well, we put everything on a spreadsheet where it's kind of a lifetime income plan. So we want to re-enter the actual current values of all the investments. We have a review sheet that we always have prepared that shows all the accounts, what was put in them at inception, what they're worth today, how much has been taken out of them for income or other purposes, withdrawals or whatever, or, rebalancing to a different type of asset class or funding a LERP or whatever. So we kind of look at where the money flows has been over the past year. We can also go back to the original plan and see, where we were when we started. Maybe it was 4 or 5 years ago. Now we're in our 5th or 6th year, and we update the plan. We want to make sure that we're not seeing big losses on the plans. Now in 2022, there was a certain portion of most of our clients' assets that were at risk, and so if 30% of them were at risk and we got out 15 to 20% down, they might be down 4 or 5% on that particular of the entire on an effective rate, down 5 or 6%. So does that mean the whole plan is ruined? No, usually we build enough buffer, and what we want to do is minimize or eliminate losses. So, from that time, have we made some of that money back? Yeah, we have. We've made some because the market's bounced up and the indexed products have done well. Those that didn't lose money, still went up at least one of the last 2 years in most cases. The risk money that we took out of the market has gone into shorter term type interest-bearing accounts that have been growing at between, 5 and 8%-ish. And so, we've been able to make those losses back on those assets as well as the upside on the new assets. So maybe we had a flat year or two. Does that ruin the whole plan? No, because we plan to make, maybe we've got a plan that, we assume a growth rate of 5 or 6% over time. Part of that's in the market, part of that's with index products. And if we have a few flat years, does that mean that we're not going to make it back? No, it means, when the market looks better, maybe that 20 or 30% of the portfolio is going to go into something that's making 10 or 20% when the market gets back to a real bull market that looks more normal with some fundamental backing. meaning that things are priced a little bit more reasonable. So maybe we'll make a little bit more on the good years. So again, what we want to do is, we always build a buffer that if we have a few non-performing years, that we're going to be okay. Now, what I would really hate is if we had everybody's money under management, it went down, and let's say it was because they're retirees, we wanted to have a 60-40 split between stocks and bonds. Maybe it was even skewed towards bonds. Well, shoot, most of our clients will still be down 10 or 20% on the bond portfolio and probably not above high water, even if we'd have ridden the market out. And even worse, if they'd have been spending money for income in the last 2.5 years, we might be down 15 or 20%. That would sure look a lot worse looking 20 years ahead on the plan, having basically locked in those losses or, taken those losses on that money that we had to spend that we know is not going to come back when the market goes up again. So our main focus is to have less losses in bad years or no losses and weather the storms when they come. And I think this last couple of years, even it's been gyrating up and down. And by and large, as I've mentioned, I believe it's, pretty manipulated. Should we just trust the manipulation to continue? Well, that's one strategy. But again, I'm kind of old school and I like the fundamentals to back that too. In the meantime, if we can, make sure we're not losing money while we're spending it, we're going to be better off and have a much longer staying power in the plan than if we were to, throw all caution to the wind or even take a little bit more risks, when we shouldn't have to. So we kind of do a risk assessment. We also look at certain assets that might not be performing. For example, I mentioned earlier, there's a lot of annuities from the past that were issued when interest rates, were only like 1 or 2%. Well, insurance companies can only do so much with 1 or 2%. If we can make 4 or 5% on those, back then we were talking big numbers. We're like, oh my gosh, I can make 4 or 5 instead of 1 in a bank. Oh my gosh, let's do this. And that was, hypothetical, returns based on historicals and potential upsides and so forth. And then, as interest rates have stayed down, many of those didn't really perform that much. Maybe we've only made 2 or 3% on them. Well, it still beat a CD if you would have bought it 5 years ago. It still would have beat a short-term treasury if you'd have bought it 5 years ago. But now interest rates are higher. So what we talk about is what assets on this spreadsheet can be upgraded or moved to something with potentially higher returns and still, or eliminate some risk. So again, we look at the risk on the risk column, make sure that we're not taking too much risk and not exposing ourselves to too many losses. And we would move away from those if you don't have risk tolerance. If you're more of a moderate or aggressive investor and you want to leave some of that alone because you have staying power or you have other income that support it, then we'll leave that alone. But again, then we'll look at those fixed products that aren't performing and say, hey, is there a better way that we can move that old product into a new product? And I'll just give you an example of a refinance situation that, we've been looking at and doing a lot of lately, actually a couple of them. And I'm doing that with my own old annuities as well. Some companies are willing to offer a bonus because they have a lot of surplus and liquidity. There's some companies that are, A-rated companies that have a lot of extra money laying around that they can make short-term interest on, or they can buy future business from clients that are kind of in a bad situation. Our group made a deal with one company to offer a product that gives you a 14% bonus up front, which will more than overcome most penalties for getting out of an old annuity. And they have a minimum guaranteed interest rate of 2.5%, where, and that might not sound like a lot, but if you're getting 14% up front and bump into a 2.5 guarantee and then a 6 or 7 or 8% cap or potential upside when the market's good, but the one you have pays a 1% fixed rate instead of a 2.5, or pays a 3% or a 2.5 or maybe even a 4% cap on the market. So the most you can make is somewhere between 1 and 4%. If you could move that and have them pay your penalty to move and have somewhere between 2.5 and 7% be your range, why wouldn't you do it? So there's plenty of opportunities that, come up in these annual reviews. And sometimes we reach out even prior to an annual review as we know that there's situations that look like they're not going to pan out. I usually like the annual review because they usually happen when like annuities and other products anniversaries are happening. And at that point, we get to at least lock in whatever profit that there was kind of going on mid-year. And at that point is usually the time when we do our annual review so that we can say, okay, this is an anniversary time. We haven't made any money yet on the other one. We've locked in the losses from the gains from last year. No losses because they don't go down. And, let's see if there's an upgrade opportunity. So again, we'll update income and other sources and just make sure you're on track. And if there's not, we'll make the adjustments.
Jeff, hate to cut you off, but time is our enemy this week. I want to thank you for your time. And again, our telephone number 520-780-9059 if you want to get in and talk to Jeff. I'm Jeff Shade. Have yourself a great weekend. And be sure to join us again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.